Welcome back to the channel, and in today's video I'm going to be reading an article for you guys. This is actually a very interesting article talking about 401k withdrawals are at a record high. It also gives you options to consider before withdrawing from your 401k. I know there are some people out there that say 401ks are not good, don't invest in your 401k because it takes forever to retire with it. I still think that 401k is probably one of the best methods of retiring, one of the best accounts you can use. Is for the person that doesn't really know much about investing, but you also have to take in mind the kind of funds you're investing into with your 401k. A record number of Americans are taking money from their 401k plans before retirement. I feel like there's so many other things you could do before taking money out of your retirement. That is literally the only money that you're going to potentially have when you're in your 60s, and you're gonna have Social Security and you're gonna have your retirement. And I just do not want to touch that. It says in 2025, 6% of Vanguard customers' retirement funds initiated a 401k hardship withdrawal. So before I talk about Vanguard customers, who knows what other accounts people are pulling from, whether that's Fidelity or TSP, wherever else, or Charles Schwab. Who knows how many people are actually pulling from the 401ks? And in the grand scheme of things, 6% is not a lot, but this is only a small study for just Vanguard. From 2024 to 2025, increased 1%. I'm sure for 2026 it's going to increase 1% as well, because the economy is tough. Everything is on the rise and people are going to start feeling the pinch, and they're going to want to pull from their 401k. Hardship withdrawals actually avoid the usual 10% penalty touching your retirement account early, provided that funds are for what the IRS calls immediate and heavy financial need, which I did not know that. If you have a hardship withdrawal, you don't pay that 10% penalty. Just pay taxes on your money. Report found that most common reasons for tapping a 401k advance were to avoid foreclosure or evictions, 36%, to pay medical expenses, 31%, to cover tuition. Wow. So tuition, when did tuition become emergency? I didn't think that tuition would become emergency. Definitely to avoid foreclosure or eviction. This is something I didn't know when we got this house. I thought the payment was going to be the same for the entire length of this house. What, it was like $600 something. You get taxes, insurance increases. Now we're talking $700, $800, even $900 a month. And this is a cheap house. Think about an expensive house. When you get in the house, your total mortgage, insurance, taxes is $2,000. The next year, it's going to be $2,500. The next year after that, it might be $2,600. Then it might go back down. Once taxes doesn't rise as much or insurance doesn't rise as much, it might go back down to $2,200 or something like that. Factor that into your decision making before buying a house, that, oh, this payment potentially will go up and it's something that we can afford. If not, then we need to buy lower. And if we can't afford it, then let's just continue with the purchase. And then medical expenses, hopefully you have health insurance, but we all know that health insurance doesn't cover everything, and it only covers a certain portion of things. So you're still on the hook for these big medical expenses, which is why having an emergency fund is very important. But it seems as if someone's pulling from the 401k, they may not have an emergency fund. And we know how difficult it is to grow an emergency fund, because we're talking about $15 or $20 or even $30,000 that someone's going to have to save for emergencies, because this is your bare bone expenses. And some people have really high expenses because they're in certain situations, or they have a big house payment or a car payment. I didn't think that covering tuition was an emergency. Withdrawing from your 401k has become one of the easiest ways to access excess capital. It's so easy to invest to your 401k, and it's probably one of the only methods that a lot of people are able to do to save money, because it's automatic and it comes out before your paycheck. It comes out pre-tax. So you put $300, $400 aside, and then that thing just begins to grow, especially if you have a good fund, and you'll see, oh wow, I have $300,000 in my 401k. I'm just gonna early withdraw $30,000 or get a loan for $30,000 from my 401k, and they don't think much of it. But you're losing out on potential gains from the market, whether that's 7%, 8%, 9%, 10%. My 401k had like a 15 or 20% rate of return. So if I took a loan on my 401k, pay that back at what, 4% or 5%, I'm missing out on a 20% rate of return on my money that I will most likely not get back and most likely not see very often during my investing time. And here's the stat: nearly half Americans don't have $1,000 for unexpected expenses, no emergency fund, no available credit, nothing. Wow, no available credit. I didn't know that. Like, I would assume that someone at least has $1,000 in credit cards that they can spend on an emergency. But I've heard that $1,000 for unexpected expenses, no cash. That is insane. Just knowing that you don't have $1,000 in your savings account is a scary, scary thing, especially when an emergency happens, because something's going to happen and you're going to have to use this money to fix this emergency, whatever it is. You're going to be very thankful that you have this emergency fund. So if you are this person that doesn't have $1,000 unexpected expenses, then you need to look at your expenses. You need to look at your life and the things that you're doing right now that is taking away from your ability to grow wealth. That's taken away from your ability to earn more money. That's taken away from your ability to save for an emergency fund. Is that your car? Is it your spending habits? Are you buying designer things? Are you buying expensive things? Are you going on too many trips? If you're going to have a better financial situation, then you need to value investing. You need to value savings. And if you don't value savings, then you just have to learn more about it. You have to learn the importance of saving and investing to your future, because when you turn 50, 60, 70, you want to be able to relax. You've been working for literally 40 years. You want to now relax because your body cannot take the amount of work that your 20-year-old or 30-year-old body took. So you want to invest right now while you're young, and you want to live off your investments when you get older. So 1,000 should be the absolute minimum you should have in your bank account. I would like you to have at least 1 month worth of expenses. So we're talking about $5,000, $6,000 that you should have in your bank account. And we need to work our butts off so that we can get to that number, so we can have some kind of breathing room for when things go bad. They're saying don't dip into your nest egg, even if you have an emergency. Retirement accounts are meant to fund decades of future spending. That's what I just said. It's meant to fund your future. It's not meant to fund your present. So we have to have that delayed gratification. I know we see that big balance, but we have to leave it alone because it's about to be crazy, because compound interest is going to be working so crazy. Like before you know it, you're going to be a millionaire because compound interest is building off of that $400,000. I was at work and one of these guys said, there's a point where your gains from the market within a year is more than your actual income you're bringing in. That's just how crazy compound interest is. So if you stay at it, continue to invest. If someone takes money out early, they're not just losing the amount withdrawn, they're losing years or decades of compound interest. Like people really promote this 401k loan. 401k loan, you're pulling out money and you're paying yourself back at whatever interest rate your 401k says. So 4%, 5%. But you're also missing out on the gains of the market. So you're paying yourself back, but then you also have to continue to fund your 401k. My understanding is that you also pay your loan back, but then you have to continue to fund your 401k. So you're almost paying double towards your retirement. That's less money in your pocket for the end of the day. If you just don't pull these 401k loans, people pull 401k loans for a backyard renovation. Do you not care about your retirement? Unless you want to pay this house off and factor in the lack of monthly payment for your house into your retirement, then I would just never do anything like that. But like I said, people see this big balance in their account because they were forced to save money. And then they're like, oh, I'm just going to use it. With an average annual return of 7%, a worker in their 30s withdrawing $10,000 from the 401k could easily be sacrificed $100K in potential earnings. Let me pull this investment calculator. We talked about the opportunity cost that you lose when you purchase a vehicle. And this is the same kind of concept this guy's talking about. $10,000. This is what would have been invested if you would have kept it there, but you pulled this out. This is what it would look like. So over a person's working career, say 30 years, and at a 7% rate of return, you don't contribute anything to it, $76,000. So over a 30-year working period, you have about $76,000. You pulled out $10,000, so you're not going to have the $76,000. So this is kind of what he's talking about. Maybe saying it's 40 years. 40 years, it's $149,000. And this is kind of the same thing that I talked about with cars. Say you pay $50K for a car. Instead of investing that $50K, you're just paying $50K flat and you're paying interest back, whatever. But if you would have kept this $50K in your retirement account, or if you kept this $50K in the brokerage account, your Roth IRA, instead of pulling it out for a car, instead of using it for a car, over 20 years at, let's say, 8% rate of return, short amount of time, that $50K was worth $233,000. That's what you're losing when you're pulling out this money. You're losing $233,000 over a period of 20 years. And say you contribute $500 to that, $517,000 over 20 years, you're missing out on because you decide to get a car loan. And you have to swallow that pill. Is that something you're okay with doing? Is that money that you can afford to lose? Then go for it. But if money that you can't afford to lose, if you can't afford to lose $50,000, then put it towards your retirement, put it towards your broker account, and let it grow. But when can you withdraw from your 401k? There's different ways, there's different times you can withdraw from your 401k. If you dip into your workplace sponsored retirement account before turning 59 and a half, the IRS usually requires you to pay income taxes on the distribution, as well as 10% early withdrawal. We don't want to do that. We don't want to pay income tax and a 10% withdrawal. I mean, that's insane. So we don't want to do that. Factor into your penalty. We don't want to do any of these options, honestly. We want to be sure that we're being smart financially and we're having a emergency fund in place so we can avoid doing things like this. Factor in the penalty and 30% for your income tax. A $10,000 withdrawal quickly becomes $6,000. So you want to pull $10,000. Now it's $6,000. So if you need $10,000, then you need to pull like $20,000. So he doesn't recommend withdrawing money from your account, but he admits that sometimes it's necessary. If you're not financially stable, if you're not in a financially good spot, then maybe it is necessary. And I would say that it probably is better than getting a personal loan. I'd probably get an interest-free credit card that gave me no interest for at least a year to 18 months. So if your family's in a bind and you absolutely don't have the cash, just use that money from your 401k. It might be the best option rather than just putting it on a credit card. These are the ways that you can get approved for a hardship loan. Remember, hardship loan is literally just you need 20K or 10K, whatever you're allowed to pull out, then you're pulling that out. You're not paying that back. Avoiding eviction, foreclosure, medical expenses. We talked about it. Tuition-related expenses for higher education. Buying a primary residence, which I'm sure some people will do. You weren't able to save down payment. Your expenses are high. Your rent is already high. How you expect to save for this down payment? You just pull from your 401k. I'm not doing that. Approved home repairs. I would not use for home repairs. Expenses related to federally declared disasters and funeral expenses, which is valid. The funerals can be very expensive, especially if you don't have life insurance. This is why life insurance is super important too, because if you pass away or your parents pass away, you can at least get money to fund the funeral, and it's not putting you in a hole or putting you in a situation where you have to pull from your 401k. Depending on your plan, you could have to provide proof of your need. Okay, so let's talk about hardship withdrawals. So workers participating in 401ks take $1,000 penalty free. Beginning 2026, you take up to $2,600. Pay for long-term care insurance. Okay. Unlike hardship withdrawals, emergency withdrawals don't require any proof and can be repaid into your account. So then here's 401k loans, which I do not think anyone should do these. You can borrow against usually $50,000. So let's skip to the alternatives of touching your 401k, because I don't want to give you guys reasons or educate you on really 401k loans, because I think they're not a good idea. But the first thing we want to have is our emergency fund, which is super important. The emergency fund is a standalone account that offers easy access to cash to replace lost income or covered expenses. You need to get all your expenses together, add them up for the month, and then multiply that by 3 or by 6, and that's 3 months or 6 months. And a lot of times when the economy is really not good or you're in an unstable situation, you might need 12 months. You might need a year of emergency expenses saved up in your high yield savings account. Unlike some other safety nets though, an emergency fund requires you to take action before you're laid off or hit with another financial emergency. Put your emergency fund in a high yield savings account. I mean, right now I have Ally and I think I'm getting about a 3.4% return on my money with Ally. Before the pandemic, or I think around the pandemic, it was like 5%. You get like a 5% return on these things, but it's a little bit lower now. Still better than a normal savings account that's giving you absolutely nothing. Just a little bit extra on top for your emergency fund, especially if you have that big number, then that means you're going to be getting more money and interest on your emergency fund. So unlike your 401k, you can draw from your emergency savings account at any time for any reason without penalty or tax implications, because this is just a bank account. You just transfer money out of your emergency fund and you pay for whatever you need to pay for. You need to work your butt off to put that money back into your emergency fund so you can have a fully stocked emergency fund again. So look at this. Workers with an ESA, emergency savings account, are 50% less likely to withdraw money early from their retirement funds. Home equity, this is pulling equity out your home. I don't need to read much about that. I'm not crazy about a HELOC. I think your emergency fund is the best way to go. IRA withdrawals, early withdrawals from traditional independent retirement accounts. IRA also comes with 10% penalty. If you have a Roth IRA, you can withdraw the contributions penalty free. So you can withdraw the money that you put into your Roth IRA. Say it's the max is like $7,000 or $7,500, whatever the max is. You contribute that, or you contribute $500, whatever it is. You can pull that out tax free. So that's another option that you have instead of going to your 401k. Instead of dipping into your big retirement account, you can go into your Roth IRA, pull out your contributions. It should be another kind of last resort scenario because it is part of retirement and we don't want to touch our retirement, especially our Roth IRA, because that's going to be tax-free money. If you have $1 million in your Roth IRA, by the time you retire, that means you can pull out $1 million. So we want to leave that money untouched as best as possible. But if we're in a bind, if we're in a bad situation, then we can definitely pull from our Roth IRA. I think this is my favorite 0% APR credit cards, but it doesn't really apply to a mortgage if you have, or you're about to get an eviction. I don't think you can really pay for housing payment with a credit card, but this is where I would tend to, because I know that I have the discipline to pay this thing off. I'm going to be able to work super hard, whether I have to get a little side hustle or something to pay this credit card off as soon as possible. But this is kind of where I tend to go before I start pulling from my investments. If you don't have the discipline, then maybe you should not go for credit card, because once the 0% interest period stops, they're going to hit you with interest at 20, 30%. And it could be deferred interest. So because you didn't pay this credit card off, we're going to hit you with the interest that you would have been charged over the period of time that we gave you that 0% APR. I think this is my favorite way. I've done this before with our rental that we actually just sold, and I have to talk about that in another video. Are you saving too much for retirement? Looks like this is the end of the article. While most Americans are worried about outliving their retirement, you can be saving too much for your post-working years, point where you don't have available cash to cover emergencies. While hardship withdrawals are at an all-time high, 401k balances have also jumped 11% from 2024 to 25 because the market was absolutely insane, driven by strong gains in the market, like I just said. I see a lot of people who are fixated on shoveling lots of money to retirement accounts. I'm all for saving retirement, but sometimes too much for a good thing. You should be saving elsewhere so you can adjust when life happens. That's why it's important to run your numbers, because you could be funding your retirement too much and not having enough money for the present, and this could be a reason why you're in these certain situations. You have to have an emergency pool from your 401k. So I guess my take on it is pulling from your 401k, pulling from your retirement should be the last resort. I personally prefer getting a 0% APR credit card that, like I said, 12, 18 months, and I'm putting that exact amount to that card every single month so it could be paid off by that time or earlier. I guess my next one that I would do is probably pull from my Roth IRA, because me personally, like my personal financial situation, I'm going to be relying more on my 401k and my pension than I will on my Roth IRA. So that's kind of my thing. No, I guess the first thing you should be doing is pulling from your emergency fund. You have to have emergency fund, so you have to cut your expenses. You have to find out how much you need for your monthly expenses so that you can have this emergency fund in place. And if you have any emergency pop up, you can literally just pull from your savings account, your high yield savings account, and apply it to whatever emergency you have. So hope you guys enjoyed the video. If you did, leave a like, subscribe to my channel, and I'll see you guys in the next video.